Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In today's episode, I'm going to explain reporting ways of doing long-term assets and long-term liabilities. When we start talking about long-term assets, we're usually generalizing around PPE, which is property, plant, and equipment. And the difference between PPE and inventory is that PPE are things that are bought for the future investment of the company. These objects are not going to be sold immediately, or they're not really bought for being sold, but they're going to be bought for generating value or profits into the products or services that are created within the company. So basically, all of the PPE, it's going to enhance all the value that you already have, or it will be the one helping create it. And now, when we have to capitalize for costs related to PPE, it's going to be the tricky part, because all the costs that are required to bring an asset to its intended state of use are the ones that are going to be capitalized. So what does this mean? Let's imagine I'm buying a factory, and in that factory, I'm going to put a big and expensive equipment that cost me $27 million. But for installing that equipment, I'll need to pay someone to install it for $2 million, and then I'll also need to add up other stuff that will be $1 million. How much should be the value of my PPE? Should it only be the value of the thing that I just got, $27 million? Or should it be adding up all of it, $30 million? And the thing is, it should be $30 million, because in the value of property, plant, and equipment, you should always include all the freight, installation, testing, and borrowing costs that led that thing to be in the intended state of use. One thing that isn't capitalized is insurance, and this is going to be more of a prepaid expense. It's not really part of the value of the asset. But if the assets were, for example, a bundle purchase and you got many of them at the same time, you should get a percentage of allocation that should come from the appraised value over the book value. All of this means that for capitalizing this, you'll have to include lots of things. And that's what you have to consider when you see the value of a long-term asset. It's not only how much did it cost to the company, but how much did it cost to buy the thing and get it to its intended use. Now, what happens if we get a government grant? Usually, government grants are received for supporting the purchase of some investing thing, such as PPE. And there are two ways for accounting this value in the financial statements. The first way is to decrease the PPE value for that amount. So let's go back to my example where I have a PPE that's worth $30 million. If the government gave me a grant of $5 million, I could just take that value away from my PPE, and now it would have a total value of $25 million. Or the other way of doing this is adding up a liability for that amount. So I will keep my $30 million as the asset, but I'm going to add a liability for $5 million. And that's going to be my way of balancing it out. And why can you do both things? Basically because government grants are just going to be an aid that somebody's giving you. Sometimes they might put conditions that might make it a liability, but sometimes they're just helping you. So you should decrease the value from the one that you just reported, because that money was given to you extra and it was a cash inflow, but you have to balance it out somewhere. And it will be by decreasing the value of a PPE. And now, when we're talking about decreasing value of PPE, maybe you've heard about an important concept that's called depreciation. Depreciation is how much value of that property, land, or equipment is lost throughout the years or throughout its usage. And there are three methods for calculating depreciation. The first method is the straight line depreciation. This one I mentioned it in another episode, but what you have to do is take the cost that you took from that object that you bought or the thing that you just bought and take away the residual value. This is going to be the value that you're expecting to sell it for. If we went back to my example, let's say I'm going to only use that machinery for 5 years and then I'm planning on selling it for $10 million. So I would take my 30 million minus the 10 million that I'm expecting to buy. So let's say technically I'm going to use 20 million of that machinery, and then we're going to divide it by the time that you want to use it for. This time, it's commonly considered as the useful life of an object. And so this method is the most common one because it's pretty simple. That's why it's called straight line depreciation. You're depreciating a little bit each time that you're doing this. But there are other two methods that are commonly used. One of them, it's the units of production. And this one, it's going to be kind of similar. You take the cost minus the residual value, but in this case, you are not going to divide it by the time, but by the total capacity of production. And if you've already used a little bit of that production, then you would take the units produced over the total capacity, and that would give you the percentage of what you have left from that asset. So let's say my machinery could produce 20,000 units. If I already produced 10,000 units, I can measure it from that ratio. I know that I only have 10,000 units left, so I'm going to take the cost minus the residual value and then multiply it by that ratio that I just got, the units produced over the total capacity. The third method, it's going to be the accelerated depreciation, and it's also called the double decline depreciation. And this one, it's related to a paradox where technically you're going half, and then half of that remaining half, and then half of that remaining half that you have left, and it becomes a bit of an infinity loop. But what you have to do is you'll take the cost and you'll multiply it times 1 divided the time, the useful life that you're planning, but then you'll multiply that by 2. And so that's why it's called the double decline. Every time you'll take away the cost minus the depreciation that you already have, and then you'll multiply it times the proportion 1 over useful life times 2. And here, since it's going to be kind of infinite, the residual value won't be deducted, and you're going to stop amortizing when the book value reaches the residual value of $20,000. So this method is a bit more complex, but I just mentioned the 3 methods that are used in order of popularity. The first one would be the straight line method of depreciation, then followed by the units of production depreciation, and lastly, the accelerated or double decline depreciation. Now, maybe you calculated some depreciation, but that was wrong. And this, when you're actually selling the PPE, might be called an impairment. And so an item, it's going to be impaired, or an asset, it's going to be impaired if the carrying amount that you have on your statements, which is called the book values are always going to be the values that appear on your financial statements. So if that book value, it's going to be bigger than the recoverable amount. So that means you get 2 options for deciding what is the recoverable amount. It may either be the fair value minus the disposal cost, or the value that you have in use. And why is it that 2 values can be recoverable amount? I honestly don't know the logic behind it. The thing is that you only have to choose the greatest between those 2, either fair value minus disposal cost or the value in use. And that it's going to be the recoverable amount, the greatest of those 2. And so if the carrying amount, your book value, is bigger than this one, technically it means it's impaired. And what happens when it's impaired, now talking in plain English, means that your calculations weren't wrong. And maybe you depreciated an asset more than you should have, or you depreciated it less than you should have. And so the value must be added or reduced in the counter assets, and thence you will balance it either as an expense or a gain. This, it's usually going to be called the impairment loss, because most of the times it's a loss. Companies aren't very good at calculating the value of depreciation, and that's why you'll have to incur in various impairments. But now, let's go to another stage where I was talking about the disposal of PPE, or property, plant, and equipment. This is going to look a bit more complex when we are looking at the financial statements, because the first thing you have to have in mind is going to be the cash from the sale that will be reflected in the cash flow. Then the second thing you have to have in mind is that the PPE value that you used to have in your assets is now going to turn into zero. Why? Because you no longer have the asset. So you received money, now you're going to turn the value of your PPE, whatever value this is, into zero. And if you had the accumulated depreciation, also you must turn that one into zero, because now you're no longer carrying away that value of depreciation. It's going to be zero. That asset is gone. But the thing is the remainder. So if you take the value of the PPE minus the depreciation, and then minus the sale, this will go to balance out in the retained earnings part, in equity. Because remember, always equity is the residual, so whatever you have to balance out, you'll balance it over there. And in retained earnings, you're going to balance it out as either an expense or an income, and it might be considered a gain on disposal if you earn more money than the one you wanted, or a loss on disposal if you lost money when disposing that asset. So all of this is what's covered when you're talking about property, plant, and equipment. Even though long-term assets may sound simple, they're actually more complex than you might imagine, because you have all of these factors that are surrounding it. So the disposal, the impairments, the depreciation, and also how you capitalize costs or government grants. But now we're going to switch topic, and we're going to pass not to more long-term assets, but long-term liabilities. When we're considering long-term liabilities, usually you have either long-term debt, which is going to be easy to capitalize because it's going to be similar to any loan, but you might also find bonds. And bonds, as I mentioned in my previous finances episode, are going to be a way of financing your company, but they are going to have weird names on their elements. And every bond that you might see is going to include three things. First, it's going to include the face value, which is the payment that you'll have to do at maturity of that bond. Maturity, the second thing, which is going to be the period for the one that you're going to hold. So let's say my maturity might be 10 years. I would hold the bond that I have up till 2033. So 10 years from now, that would be maturity. And in that year, I would have to pay the face value. But in the meantime, you would have to consider the third element, which are going to be the coupons. And the coupon payments are going to be the coupon rate, which is a number that's given to you, multiplied by the face value. So I might get a bond of $100 face value with a coupon of 5%. And that means I'm going to do coupon payments of 5 in the periods that I'm asked to do it when I'm negotiating the bond. But this coupon payment will be done regularly. Usually it's semi-annually, and you're going to be doing these payments, but they are multiplied by the face value times the coupon rate. And always that you consider all of these bonds, they're going to be recognized as liabilities, but what happens is that their value might be changing, because you don't always buy a bond for its face value. You may buy it in 3 different ways. First, there may be a bond that you buy at face value, and this is called a bond at par. Par means that the coupon rate, it's the same as the market rate, so you're getting perfect rates, and that means that the cash that you proceeded from the bond it's the same as the face value from the bond. And even though this sounds like the simple and most intuitive example, you'll find that not all bonds are bought this way. You might also get a bond at a discount. And this means that you are buying it from a lower price than the face value. So the person that got the bond is paying less than the money that's promised at the end. And why is this? Because usually the coupon rate is going to be smaller than the market rate. So if you are earning less money by putting your money in that coupon than in the market, you'll have to compensate it somehow. And the person buying the bond will usually think about it this way and will say, I will pay less for this because it's giving me less returns. So why should I put my money here if it's not giving me the same returns? Well, for paying less, technically you're getting that extra piece of savings or money that you didn't get at the market. So when the coupon rate is smaller than the market rate, you'll buy things at a discount, at a lower price. But you might also get the other possibility of buying a bond at a premium. And this means that your coupon rate will be higher than the market rate, which means that you'll get even more money than if you had put it in the market. And this is very attractive. So you might imagine that people are not going to buy it at their normal price. They're going to be willing to pay more for getting that higher return. So 3 ways: at a par, at a discount, or at a premium. And then comes the hard part. How do you capitalize all of this long-term liabilities in bonds? Well, there exists a method called the effective interest method. And for this, you have to consider the effective rate, which is usually the market rate. And this effective rate, it's going to be used for calculating something that's called the interest expense. So the interest expense, it's going to be the effective rate, the market rate, times the book value of the bond that you have. Why do we do this? Basically to keep our bond into real life value, into real market value. And so what's going to happen is that your payment, which is the coupon payment at the coupon rate, it's going to be added to these things into a big equation that will give you the updated value of your bond. So let's see. For getting that updated book value of your bond, you should start with the previous one, and then you're going to add the interest expense, because technically, if we're talking in market terms, that's the interest that you're getting for the money. But then from that interest, we're going to take away the payment because you're making regular payments for these bonds that are called the coupons. And if we follow this process, book value plus interest expense minus the coupon payment, this will give you an updated book value of your bond. This effective interest method allows you to represent the real value of your bond. And what happens is that you will be able to notice if bonds were bought at a premium or at a discount, because, for example, at a premium payment, you would get the coupons higher than the interest expense because you're paying more for that bond. But if it's in a discount, you would get the opposite. The payments would be smaller than your interest expense, and then you would balance it out again in the equity part, such as an expense or a revenue. When you're going to redeem a bond, which is the last step, then you should always take out the cash part from your statements, which is the value that you paid for the redemption. And then in the liabilities, you're going to take away the book value of the bond, which is the one that you used to have. That liability is now gone because you no longer have the bond. And the difference, which is what I was telling you, either from the cash and the book value, because you may pay different things, it's going to always appear in the equity as an expense, or maybe as revenue. So here is a big explanation on long-term assets and long-term liabilities. And I hope listening to this helps you clarify all your doubts. I'll see you next week.